Good morning. It's Ted Bader here, the president of SIA Wealth. Thanks everyone for joining our weekly webinars. We've been doing this now for I think about 6 weeks, and it always seems that there's new things to talk about on a weekly basis. That's how fast things are changing. I hope everyone's staying safe, and I'll get into it talking a little bit about our funds, but I did want to mention from a housekeeping point of view, if anyone has any questions, you can write them in on the question tab and we will get to them at the end. We're going to leave a little bit of time at the end to go over any of the questions, so please feel free to write that out and I will answer them at the end. But without much further ado, I'm going to kind of give you an update. Switch slides, please. Oh, yeah, so one more. I'm going to talk for a few minutes. Jason Lee Swee, our Executive Vice President, introduced the concept of Advisor Alpha, so tactical asset allocation. If you go to the next slide, we had an awful lot of feedback from what Jason was talking about, very, very positive feedback. So I wanted to expand on it. One of the biggest questions that we get regarding the funds that SIA Wealth manages for BMO is, where do they fit? And we do get a lot of comments about how our funds are doing versus benchmarks, and about how our funds are tactical, and what it is they're doing. Is it a core fund? Is it an explore fund? Is it an alternative fund? And really the answer is all of the above. And this is really, speaking frankly, this is why we wanted to talk to advisors about where these funds fit, because they cover a huge area of investment landscape. And so that's why we're making the case for a tactical sleeve, because we are not a long-only US fund, or we're not a long-only Canadian fund, or we're not a bond fund, or we're not an emerging markets fund, but we are all of the above at certain times, depending on our system. And that's really an important aspect of where this fits. If you go to the next slide, this is what Jason posted last week, and a lot of people really appreciated this because it shows you how important tactical asset allocation is. Now, you as an advisor have that ability to overweight, the TSX composite when we're in a commodity bull market, or over the last 10 years to overweight the US. And this is exactly what the funds we're trying to do. If in the last 5 years that we've been running these funds for BMO, for example, are we the strongest US manager out there? Probably not. But do we have a huge proportion of our assets into the US? The reality is yes, we did. So it's important to understand where our benchmarks are and what we're trying to compete against. And we're not trying to compete against peers who are laser focused on one area. We're trying to be that tactical manager that will be able to switch. So we do fit in as a core allocation to a lot of advisors by getting that asset allocation right. If the majority of our assets over the last 5 years have been into the US, we've made that tactical asset allocation call correct. If you go to the next slide, this is where it comes into the explore aspect. If we were a emerging market manager, we looked like heroes all the way up until 2007. But we're not. We are going to get that exposure if it's starting to be strong. So in our asset allocation models, we will get some exposure to emerging market equities at different times. We'll also get some exposure to US small cap at different times if that's ranked well. What we've seen over the last 5 years is the large caps have outperformed, but the point is, using this explore model where you can laser focus in on a strong US small cap manager, or an emerging market manager, or a gold manager, or just buying gold bullion, what we're trying to do is get you that explore layer in the overall picture of what it is we're doing. So we fit the bill for an explore point of view. It's never going to be the entire portfolio, but you are going to be able to have that sliver. So my point is, we're trying to be that tactical manager that gets that exposure to those things that are going well, plus getting out of the way. If you're an emerging market manager, you're going to get exceptionally hurt during those crashes because that's what you're supposed to be invested in. We have that ability to tactically shift out of the way. And finally, the next slide goes to a very important point, is the alternative strategy. I'm having lots of conversations with advisors who've started to build out a 20% sleeve in the alternative space. They're using hedge funds, market neutral funds, long short funds, a lot of other things. if you think about some of the funds that we run with BMO right now, we are a long flat fund. We don't go short, we don't take any short risk on, but we have the ability to get completely out of the equity markets. And today, that's what we are. So here's an example of the Canadian market versus the equity market versus the bond market. For the first decade of the 2000s, as you can see, it made sense to be a Canadian equity manager, except during the 2001, 2002 bear market and the 2008 bear market. By using our equity action call as an overlay, we do have that ability to shift completely out of equities. And today, our equity strategies for BMO have zero equities in it. We're in effect the bond fund. Yet we get benchmarked to a lot of equity strategies, and given the rally over the last few weeks, we look to be underperforming. I understand that, and in that small sample size, it's correct, but what we're trying to do is give you a larger picture. Looking over these decades is by us being able to switch from equities to bonds, it makes that case to add a significant amount of value over a longer period of time. When we're invested in equities, it makes the value of being overweight U.S. equities with getting some small cap or emerging market or gold exposure. But this is the value that we're trying to bring, and this is why it warrants that tactical component. And I am saying from that 10 to 20% sleeve, because it makes it significant, is we're not going to probably be the best bond fund managers out there or emerging market managers out there, but we do have that ability to reduce the drawdown and to get that exposure where the strength is. If you go to the next slide, you'll see really all of our mandates are unconstrained and all of our mandates are tactical. We have one that's limited within Canada, since that's quite a large asset class for a lot of people. But this is exactly what we're trying to do, and understand that comparing us to an equity benchmark today isn't really an apples-to-apples comparison, because we truly are a quasi-alternative fund. No, we're not a hedge fund. No, we're not illiquid. We're very liquid, but right now we have that ability, and we are completely out of the equity markets. And when our system changes, we will get fully invested again. And that's, I think, really the value of having that tactical sleeve to complement some of your other alternative hedge funds that will underperform when markets are going up. Some of those long equity funds that will underperform when markets are going down. And this has our ability to shift your overweights, underweights, depending on the market conditions at the time. So that was it from my point of view. I really wanted people to understand the value that I believe SIA Wealth is bringing. These are the mandates that we run with BMO. If anyone has any questions, give me a call, but that's why I think something that is tactical and has that ability to move, like we've shown we do have the ability to move over the last 5 years, is quite important to the situation. So now, I know you all didn't want to listen to me, and I'll pass it over to Jeremy to give you the current market update. Thank you.
Thanks, Ted, and thanks everyone for taking the time to join us today. I'm just going to jump right in here and get to our top level of analysis. That's the equity action call. We remain in yellow as of yesterday's close. The rally has gone on, as Ted mentioned, for some time here. But what we've seen up until recently is that it still remains in a cap-weighted basis. I'm sure many of you have seen lots of articles about 5 stocks running the S&P 500, and that's not very far from the truth as far as what we've been seeing as well. So we remain in the yellow zone. That keeps us in that cautionary stance. If we move back into the green zone, we'll re-engage with equity in our mandates with BMO up to their highest level, but we're not quite there as of yet. On our second level of analysis, our asset class rankings, we can see that there was no change from last week. We still have the safest of all asset classes ranked number 1 and number 2. We've got cash at top with currency, which is just short-term money market in instruments outside of Canada and the United States, whereas cash is short-term financial instruments within the United States and Canada. International equity has been in third place for a while. It is very close to pressing currency and maybe even cash into those top 2 asset classes. That would be an important move for us, because when we are making our purchases for the BMO mandates, we're only purchasing from the top 2 asset classes. So even if we were in green today, our selection would be cash or currency, which we obviously can't take any equity exposure from. Commodities is neck and neck with U.S. equities. We're watching that very closely to see if there's a change in that. And again, just like last week, bonds is buried in the 7th position. This is quite telling, and some of the cash flow analysis that we've seen suggests that there's been significant fixed income reduction in portfolios, and maybe we're seeing some of that exposure moving back to equities and instead of cash or currency. So we'll see how things shape up given today's bullish move. So I'm going to go back to the chart that I've showed here for a number of weeks, which is our SIA market equal weight index versus our SIA cash equal weight index. So essentially US, Canadian, and international equity versus short-term money market instruments. We've seen for some time here, you can see that we've been moving up in a short-term basis. The SMAX score here is positive. And what we are looking at on the chart is when you see a downtrend, this is when you want to favor money market, cash over equities. When it's moving up, as we see from the bottom of the chart there, in the early part of 2009, right up until 2020, we saw a strong bullish run with equities dominating on cash. So we're just watching to see if that transition happens over on a short-term basis. We've seen the SMAX score improve, so that's bullish for equities. It's largely been driven by the mega caps and the larger stocks within Universe, but we have seen some improvement with the smaller and mid-sized companies over the last few trading sessions. So we're watching as that goes, and we'll see if there's any changes with today's activity. The next chart I want to look at is SIA International Equity versus SIA Bonds. So I haven't brought up the equity versus bonds. This is a chart that I traditionally use going back into the late 1990s. I was using this chart as a method to gauge interest in equities, and we can see that international equity versus bonds still remains relatively weak compared to its peak back in the early part of 2020. We can see it's down from there, but it has been building up a base, and now we're sitting at resistance under its downtrend line. So this is an important technical position. This is something that I watch for improvement when I'm looking at equities versus fixed income, is to see a breakout above there. We would suggest would be bullish. We do see an SMAX of 6, which is positive on it. So starting to look a little bit better, but we can see on a relationship basis, which is everything we do, on a relative strength basis, that we still sit considerably lower versus where we were at the beginning of the year when we look at the interest in equities over fixed income. The next chart I want to look at, again, I'm just going to go through the international US and Canadian equities, but this one here is US equities versus bonds. Very, very similar chart to what we see with the international chart. We're up against the downtrend line, still approximately half of the way up, recovery versus where we were at the beginning of the year. So that relationship between equity and bonds, equities, even with bonds buried in the very bottom of the asset classes, remains still relatively weak. And this is showing us again where money flows are going. So even though the indexes, the cap-weighted benchmarks have performed extremely well, we still see in that broad base, so when we're using equal weight benchmarks, that there's still weakness. But the positive side of what we're seeing here, almost identical to what we saw in international, is that we're at that downtrend line and possibly seeing a breakout above that. So technically, that's interesting chart for me. We've seen a lot of evidence that over the last few sessions that there's getting more broad-based interest in this rally, and that's something we've been waiting for before engaging back into the markets and expecting a green equity action call when we do see that for a short period of time. The next chart I want to look at is the SIA Canadian Equity Equal Weight Index versus the SIA Bond Equal Weight Index. This one's a little bit different compared to what we saw with international and U.S. equities, the two equity asset classes which are ranked higher than Canada within the asset class rankings. A much, much steeper decline in the relationship when the crisis began, but has returned upwards, just sitting well below its downtrend line versus the other two equity benchmarks. So we're watching this one very closely. On a short-term basis, it's got a positive SMAX, so we'll watch this again. But we would expect, if we move green equity action call, that the main areas of purchase would be international and U.S. equity at this time, as Canada continues to lag on a relative basis from them. as I mentioned earlier, and this is a chart I've pulled up from week to week, what we've been waiting for to give us some expectation that the equity action call, that this rally might have some legs to it, is for small caps to start to at least perform in line with the large caps and hopefully start to outperform the large caps, and we get that depth in the rally that's going to give us more understanding of how broad that cash flow is going back into equities, which has not been that strong. It's only been in the cap-weighted benchmarks as of late. But this chart here, watching at it from last week, we were in a column of O's testing the bottom side of this chart. That has changed, so we've moved back into a column of X's and actually moved against short-term resistance. This is not a massively excitable event, but it is positive. We see a short-term S-max of 3, which again shows that even on a shorter-term basis, those mega caps are outperforming. But if you go down to a micro-term basis over the last week, we're certainly seeing an improvement there. And over the last few trading sessions, seeing the Russell 2000 performing much, much better than it has versus the S&P 500. So again, we're watching this very closely. If this continues to improve in favor of small caps, this again would give us more strength and a bullish sentiment on that. If it reverses down again, we would see that as a relatively bearish sign for equity markets. A chart that I've normally had in this position over the last little while is crude oil, and I think everyone's very aware of the volatility that's been there, but we've seen a very strong divergence with the equities, the underlying stocks that relate or have a strong relationship to crude's price. The capped energy ETF index within Canada, it's been extremely volatile, but it's been moving up. So the last time I updated this, I was talking about it as a potential trading vehicle for those of you who are looking to trade in a market that's been extremely volatile. We've seen resistance taken out at that 442 level, so that's positive. That gives us upside potential up into the high fives. So an extremely bullish looking chart coming off grossly oversold levels. We've got support nearby at 370, so that's not that far away as far as support, so that's a relatively positive position for it as well. So this is one to watch. It's a part of the TSX composite, and that has dramatically underperformed, the financials and the technologies for quite some time. If we see that this can come back in, that might give us some impetus to see Canada improve in the asset class ranking. So I would look for this because energy remains still a relatively strong portion of the TSX composite. So a trading position, not something that we're participating in at this time because we're not in a green equity action call, but something for you to watch for, and again, would give us some commentary to give to our Canadian clients if we continue to see that strengthen up. The next chart I want to look at is high-grade copper. I pull this up, and I've always watched this chart very closely for indications of economic growth. Copper is seen as a strong barometer for that, especially given the consumption that happens out of China these days with their manufacturing base. We have seen a column of X's appear on this. I highlighted this chart back at the beginning of the month or near the beginning of the month. We had 4 X's at that time. We've moved up 1. So it's not moving up extremely fast, but it is moving in a positive direction. We still see a short-term S-max of 3, which is negative. So it still has not got that real jump to it that we would want to see if we're going to see a prolonged rally in copper, which would give us a better, hopefully a better understanding of economic growth within the global environment. So we're watching this very, very closely. We'd love to see that 249 level taken out as far as resistance. That's our next test from here, and see that S-max score move to a positive level. But again, we're watching this more for as a barometer of economic growth. $2.08 of support. Seeing that taken out would not suggest that the stock market activity is measuring economic growth going forward. The final chart I want to look at today, and one that certainly many of our investors in our tactical global equity fund are interested in is US dollar versus Canadian dollar. On a short-term basis, I've got this down to a 0.5% box, so this is going to inflate the movements within them, but I wanted to show a more near-term measurement of what's happening in the relationship. We did have a pullback from resistance. That was to be expected in late March. We reached up to those levels that we saw in 2016. Certainly, central banks have fought this resistance level from being taken out. And we saw that again happen from here, and we saw a short-term pullback to that 139.18 level shown on the chart. Since then, we saw a short rally back. It's not showing as a column of O's today, but we would move to a column of O's if we closed where we were, at least when I started the presentation here today, in a column of O's. But where we're watching for our assessment of US dollar, Canadian dollars, that 138.49, that would be our first sign of significant risk in the US dollar position, and would look at making changes, potential changes to that if we cross that level. There are other factors that we do look at, but that would be a first sign, warning sign. To the upside, it would be that 141.99. So those watching the currency, that 141.99 is the level that we would like to see come up and return the US dollar to bullish movement from here. With that, I just want to do a quick update on the charts. In conclusion, we've really just want to touch on some of the bullishness that we've seen in the marketplace that has moved the indicators up. The asset class rankings have gotten a lot closer than they have been for most of this rally over the last few weeks. It has not made significant adjustments and pressure on those cash and currency. We are seeing international equity creeping up on that. So it'll be telling if we close where we are at today. We could be very close to that level, but we'll report on that. If it does happen, if we do move to the green zone on some of the bullishness that we've seen today and over the last little bit, we will do an update when that happens. And if it happens tonight, we will do another update tomorrow so that you have relevant information to go to your clients with. With that, I think we'll open it up to questions. I believe, Ted, you've got those questions ready to go.
Yeah, we have a number of questions that have come in. Most of them are regarding the asset class ranking and equity action call. So I'll go over those for you, Jeremy. If anyone else has any questions, just please type them in. So first one, how can a subscriber to SIACharts tell how close each asset class ranking to each other is? So you said commodities in US were pretty much tied. Is there any way for an advisor to see how close they are, or? No.
We tend not to, we don't publicize that information just simply because we don't want people to try to forecast where it's going to go and start acting ahead of that. We've done tremendous testing with it, and that leads to some significant mistakes. What we've seen previously, and that's why I'm not pounding the drum that we are going to switch to green even with today's activity, is that for the most part, the markets tend to put us in a very uncomfortable position just before they fail us. So we've seen this bullish action. It would tend to, in every bear market that I've been involved with for the last 24 years, we've always been pushed at those points where we think, okay, it's for sure got to go, and then it doesn't. So quite often you'll see at those resistance and support levels that it won't go. And so by sharing that information, you could be hit with a very, very bad decision on that. So that's something we keep proprietary as well within our system.
Yeah, and kind of a follow-up question is, what would the asset class ranking, what's the weakest asset class from an equity standpoint for it to go green? Like, would the US have to shoot up to number 1, or would it have to go up to at least 2 or 3? I guess it's kind of a hypothetical question, but cash and currency could remain 1 and 2, or does that have to be replaced by an equity asset class in order for us to go green?
Yeah, we've never had a situation where an equity asset class wasn't in the top 2 positions when this, for us to go to a green. We are seeing something that's quite unique in this downturn versus other downturns, and that's bonds being buried at the bottom. Traditionally, that wouldn't be the case in a bear market status. Bonds would be 1 or 2, so that's generally seen as a more a safe haven where investors are looking for returns, and I think really highlights the risk that large institutions are seeing in fixed income at this time. Certainly there's going to be a number of corporations that will not be in good shape post this crisis. The amount of debt that's going to be issued by governments and corporations after this is going to be significant. So you've got some real risk on that. So we wouldn't expect us to go to green without at least one equity asset class being up there. International equity, waving my magic wand as far as forecasting would be the one we would expect to show up in first or second, and that could be enough. The other things is different. Commodities is ranked reasonably high too. So we have in the 4th position. So we have 3 of the top 4 are non-equity positions. So we would expect that hopefully U.S. or Canadian equity would come over commodities as well.
So yeah, so you'd need to obviously see some move up from an equity asset classes. But really, I guess another way to think about it is that because the bonds are so low, if the bonds stay there, it's easier to go green. However, if bonds rise up the asset class ranking, then that's kind of a sign of bond strength or safety, and we would stay in the yellow zone at that point. Is that a safe
Correct.
assumption?
Yeah, and that's the reason why we don't like to forecast, is that even with the rally today, if bonds are being carried up in this rally, it could offset that equity gain that we're seeing as well. So, for us to get into a true green equity action call, we want to see equities dominating the 4 other asset classes. That's currency, cash, commodities, and bonds. And bonds being buried in 7th place certainly helps at this time. A rally there would offset some of the strength in equities as we go forward.
Okay. One of the questions regarding the charts that you put up, a lot of the people who listen in are SIACharts subscribers, but a lot aren't. So can you give us a brief explanation of SMAX?
Yeah, and I'll just jump back here. So the SMAX score, so when you look at this, I've got here highlighted the SIA Market Equal Weight Index versus the SIA Cash Equal Weight Index. So again, our firm is totally designed to not need you to be a technician to work with it. We're looking at any comparison chart on the general direction. We see from the bottom left in the mid part of 07, a drawdown till we get to the early part of 2009, and then it goes up from there for the strong rally up into 2020. That's our longer term trend that we're looking for, that intermediate to longer term trend. The SMAX score is highlighted in the top left corner. Anything 6 or greater is suggesting shorter term strength in that. So that's that 1 to 3 month time frame when you see a positive SMAX. So that's just a way for us to get an earlier indicator of potential strength. So it's not necessarily a great thing to trade on its own merits. Extremely short-term in nature. It's not uncommon to see when you see transitions on comparison charts like this, or any of the measurements we do within the equity action call or asset class rankings, for it to go positive short-term and then go negative, positive, negative, a number of times before you get that intermediate trend in there. But it is a way for us to measure some of the validity of the strength. So one of the things that's been cautionary about what's happened in much of the rally over the last month is that we saw these SMAX scores staying still bearish, and that really was again just highlighting a lot of the lack of depth or breadth within the market in that rally. So seeing this one positive now over the last couple of weeks is starting to get us some of that more bullish sentiment that we need to suggest that we have a chance of a V bottom in this downturn.
Okay. These 2 questions are asking completely opposite things, but they're related to the same. One question is, any thoughts on a market bottom? And the next question is, do you think we're going to get another big leg down? So both of them are tied into the same thing, and I guess it's what the charts are saying today versus the future. But have we seen a market bottom, or are we going to see another big leg down? And I guess the question is, what's your best guess?
Well, yeah, if we go to a green equity action call, we would suggest that we're going to see at least an intermediate bottom in the market. So that would give us impetus that we probably have, to the fall before there's significant risk. There's going to be volatility. There's going to be lots of bad news coming out in May. We know that earnings and we know GDP numbers are going to continue to weaken as we start to measure out the second quarter of 2020. But if we do go to a green, that would suggest an intermediate term bottom. And then we would be dealing with that have an expectation we'd be dealing with the risk at least 6 months out. So that gets us into the fall. when I look at the charts, my excitement level is not entirely there. It's getting a little bit better only over the last few days as we started to see some of these smaller and mid-sized companies starting to participate. This is probably coming largely from the reopening of the economies around the world, which are, certainly most of those smaller companies are not built out in the web like the Amazons, the Apples, the Microsofts of the world. They're not those types of businesses. So they're more reliant on the consumer being able to get out and about and make some purchases from there. So the charts that I'm looking at today do not give me tremendous excitement from a very long-term aspect. From an intermediate-term point of view, if we see an EAC green, I would be bullish over that 6-month time frame.
Okay, so that kind of leads into another question is, if you are saying that we do have the potential to see a short-term rally, we go green, how quick, and then saying that there could be weakness going into the fall, how quickly could we get back out of the market? How quickly could we go from green back down to yellow and red? Has that ever happened in our system where we see a move back green only to see it reverse quickly back to yellow?
Let me just pull in here. Generally not. In 2006, we did see a move where we went from the yellow zone into the green zone. We spent, as I said, probably about 9 months or so, it looks like, within the green zone and then moved back in the yellow. So we haven't seen short-term spikes back into the green and then back into the yellow and then the red. That tends not to happen from our use of the system and the design of the system. It is a little bit different this time with how quickly we went into the red zone. I think that the markets had to absorb that. We're now seeing unprecedented support from the Fed. This is why we saw such a narrow rally in the markets. It's going to take a lot of work to work out, and certainly I can't find too many people on the valuation side that are very bullish on stocks. But we would expect if we go in the green that we would remain there for at least 6 months. Would be the best forecast that I could give on that. I think that a lot of the bad news and what's going to happen, and maybe the Fed and the other central banks around the world and governments might run out of steam to carry the markets as much as they have over the last month or so. That might weaken in the fall again. So I think timing-wise, there'll be lots of work. And then keep in mind, too, the likely opportunities for us in a green zone may not be in those mega caps. I think that you will see those in our portfolios from the standpoint of their relative strength, but continued interest in the exchange-traded fund markets could drive that. But if you look at the charts, for example, some of those mid-small cap indexes, they've got lots of room to go to even remotely catch up to what we've seen happen on those mega caps. So there are opportunities will present themselves should we go green.
Okay. One of the things that you have spoken about in previous webinars, I don't think I saw it today, but what is the resistance level you're seeing for the S&P 500? I don't know if you put that chart up or you know it offhand.
Yeah, we've done it, it's around 2,900, so we're very, very close to that level, to breaking above that. I don't have that chart up today. I did believe have it last week or the week before on there, so that's something for us to watch closely. Again, if we once we close today, if we do close at the levels we're at, we will do an update. So if we don't do a full-blown webinar, we will certainly email all this information out to participants in previous webinars, but I suspect we'll get onto a very quickly run webinar just to talk about the green, and we'll highlight some of those new support and resistance levels, because we are at key resistance in so many places within the market. It'll be interesting to see and do some assessment this evening. If we bust above those, it'll be quite telling and give us some levels of support that we can use as we move forward with this if we move into a bull market status.
Okay. Next question is fund related. So I'm going to bring in Paul Vendrinsky. Regarding the bond fund, what's the duration of our bond positions? And do we believe that if we own longer term bonds, are they anchored right now because of Fed bond buying?
Good question. First of all, we do have in our equity-based products, we're in very short-term bonds. So that's the ultra short-term around the 0.5 years mark. So that's just, basically a cash equivalent. But looking specifically at our bond fund, the the holdings we own now are predominantly mid to longer term in duration. Overall in that fund, we're sitting just under 10 years. So it's not too far out. We shifted the duration over the last month here up a little bit from that 8-ish to the 10-ish. The big significant change was moving from corporates to the treasuries, really on both sides of the border. To your question, I think it's also with the Fed buying, but also the anticipation that we won't be seeing interest rates move up anytime soon is really why we've seen the longer end or the longer terms outperform everything else. We'll see how this continues based on our rankings, but this is something we've seen actually for a few years now, holding that mid to longer term as far as where we're seeing strength. So where that continues, we'll see. And then I'll point out within our asset allocation fund, since we're 60% of what we own in that bond fund and 40% in those ultra short terms, the overall duration of that product is sitting around 6 years at this point.
Okay. Another fun question, Paul. Our ETFs that we run with BMO, ZFN, and ZFC, the North American and Canadian focus, if we get invested when it goes to green, what will it be invested? I guess the question is, would it be 100% invested? And what, I mean, we're not going to say the names, but what, any sectors that are ranked high, kind of an idea?
So within SIA, obviously, we're looking at a pretty broad picture of the Canadian markets, and then the ZFN, we're looking at both sides of the border, so the strongest Canadian and U.S. names. So essentially, if we move into the green zone, we are going to shift out of those ultra short-term bonds into the markets, whether it takes that a day or a few or up to a week, depending on liquidity. We are going to move into the positions where we're seeing strength. Of course, if and when it does happen, we're buying into the top names with certain sector restraints. But what we've seen, if you're a chart subscriber now, you can probably see where we're seeing a lot of strength. Strength's continuing within the metals and mining sector. We're seeing some strength in energy. We're seeing strength in technology on both sides of the border, and strength within healthcare and drugs. So not a lot. Except for the new strength in metals and mining. Not a lot has changed since the start of the year, but we'll see what we go into. Again, it's based on the rankings on those individual reports for those funds. But good question.
Okay, thanks, Paul. Jeremy, I think you wanted to mention something now. Regarding the S&P 500.
Regarding sorry, I was on mute there. I pulled up the SPX chart from the 14th of April, showing the strong resistance. So this is what we've been watching for. There's resistance right from that 28.95 up to that 29.53 level. The S&P is right at 29.44, so within 10 points of breaking that top resistance. So that's what we were watching. I just pulled that chart up here. So that's a resistance level. We'll be interested to see break through that. But again, I think probably more telling in the rally today and yesterday is what's happening with the small and mid caps, which are seeing stronger rally into it. So we'll certainly update that if we see a change in our EAC going forward.
Okay, that's it for the questions that have come in, but I wanted to thank everyone for sending in the questions. I think it was a bit of a great conversation after the update to kind of help people understand a bit about what we're seeing, what could trigger things going forward, and how that would affect the funds that we run with SIA. So thanks everyone for listening in. We're going to do it again next week, and we'll make sure everyone is fully aware if any changes do happen. So I'll pass it off to Jeremy for a final sign off.
Yeah, thanks. Thanks everyone again for your time today. Very, very interesting market conditions, but there's a lot to be seen in the charts. So we're excited to see that they are giving us good information at this time. So if we do have a change overnight, we'll certainly have an update for you tomorrow. So watch for that email if we do a webinar or just do a recording, just update that. We'll try to get that out to you. Certainly the turnaround time will be very quick. If you have any questions, as always, take advantage of contacting myself or any members of the SIA Wealth team. Thank you.